I can unequivocally say it's the bottom of the market. I was asked by a broker this morning what the symbol was for VTT. Our forward-looking statement, it's been increased due to, as Eric mentioned, we have a PEA out in several weeks. On the second page of the forward-looking statement, we list the variables we used in the PEA for time. I won't get into them now, but I'll be available at the booth and would be certainly happy to go through those with you. Our board, it's myself, a fellow named the co-founder of the company, Peter Valgaris. Peter is a mining engineer and a geologist. Peter was responsible for us vending in the Pegmont project located in Queensland, Australia. Peter was the former underground development manager for Oyu Tolgoi with Robert Friedland. He did all the underground development there. He also does the peer-to-peer analysis for Lundin Mining and is a consultant for Dundee Precious Metals. David Baker is currently working with Robert Friedland on one of his companies and is the former treasurer of Ivanhoe. And Doug Flegg is the former head of institutional sales mining for Bank of Montreal. All of the directors have significant experience in financings, takeovers, and mergers and acquisitions, and the monetizing of assets. When we put the company together, the goal was to demonstrate the economic viability of the Pegmont ore body, and that was in 2014. Internally, what we thought we would need to get to would be around 15 million tons of lead zinc mining on our best 10. And I think we'll find out whether we've reached that goal. We certainly have on the tonnage, but we'll be able to determine the viability over the next month as our PEA comes out. Some of the key tenets of the PEA are we're using the resource we recently put out, which shows a total of 14 million tons, and I'll break it out for you in a second in the inferred and indicated categories. There's a large open pit component to the ore body now, which is significant, and that should impact the economics greatly. And we're able to blend our high-grade ore, which fortuitously is located close to those pits. We're going to go with a 1 million ton per annum mill, processing plant, and we can produce both a separate lead and zinc float, which is key. As far as the local infrastructure, we are going to use there's two mines in the area, Cannington and Osborne. Osborne's agreed to let us use their airstrip, and they've also will use their camp for construction purposes. One of the key things that we recently found out is we will not need to have an above-ground tailings dam. That saves us tens of millions of dollars on our CapEx, and that'll also come out the actual numbers in the PEA, so that's significant moving forward. We're 15 kilometers from natural gas, so power isn't an issue. We're 4 kilometers from haul roads, so transportation costs will not be an issue. The marketability of the concentrate has been confirmed. We do have marketable cons, and they're clean concentrates, so we're not saddled with significant deleterious elements, so it impact the economics of the ore body. The environmental impact studies are well underway, and we'll be continuing those next year. And one of the things that we did, and pricing is always a concern, from the get-go, we used long-term consensus metal pricing, which is close to what it is today. Just quickly on the resource side, as I mentioned, the goal was to get to 15 million tons in the open pit. We're 5 million in indicated, 4 million in inferred. Underground, we're 5.7 million total. Here's just an overview of the open pit shells. We have increased the open pit component from the inferred category to indicated by 50%. The grade has increased, as one would expect, and now over 2/3 of the ore body is in the open pit category. It's 1.8 kilometers, or 18 football fields long by 6 football fields wide, so it's a significant ore body. It's still open. It will get bigger. One of the key advantages I think we have at Pegmont is the location. We're in the heart of an established mining district, and the infrastructure is phenomenal. We have 2 mills close by, Now, there's two mills within 25 kilometers. Conventional wisdom is we don't need to build a third mill. On our preliminary economic assessment, we've done it as a standalone operation. And the reason we did that, we felt that if we could demonstrate that the economics are robust as a standalone, using one of these local mills, it'll be the IRR will be on steroids. So what we hope to do is demonstrate that we've got a viable mine with a solid IRR, and then we'll determine the best route to go to monetize the ore body. Now, I'm asked all the time, do we think we'll sell it? Maybe. We are prepared to put it in production. We can put it into production. We'll be able to finance it into production, but we'll do what's ever in the best interest of the shareholders, and if a reasonable offer were to come in, we'd obviously take it to our board and then to our shareholders. Having said that, 25 kilometers away, we have Cannington, which is owned by South 32. South 32 is a $20 billion company. They're currently producing at 2.4 million tons per annum. Their mill is capacity at 3 million tons. They're under capacity. They're looking for ore. They're looking to open pit their ore body as a source for that ore. The Pegmont ore is more valuable than their open pit ore, so it makes infinite sense on paper. And they're constrained underground. They can't increase their underground mine to make up for their shortfall. So that's one opportunity for us if we go down that road. The other is the Osborne Mill, which is out of feed this year. It's owned by a Chinese private group. They're looking for solutions to keep that mill going, and I'm sure that Pegmont would fill that void for them. They currently have a 2 million ton per year mine, and it looks like we'd produce a million tons per annum, so that would work well. As I mentioned, the key strategy that we put together really revolved around, I should call this, instead of infrastructure page, strategy page, because what we did is we knew that given all the roads, the power, the rail and such, if we came close to getting to 15 million tons, we thought we could demonstrate the viability of the ore body. But what it allowed us to do was build a mine plan and then drill to that mine plan. And that's exactly what we've done. So I think when the PEA comes out, we'll demonstrate, and you can take a look at what our capital costs will be. But having all of this local certainly will help the economics immensely. Nope. Don't want to. Oh, I gave it away. One of the things I get asked a lot is, are we concerned with the recent price drop in lead zinc, and do I think the lead zinc cycle's over? And the answer is yes and no. Yes, we are concerned. You never want to see prices drop, but we were cognizant, and I think I was quite vocal about this several years ago. We expected zinc prices to rise, largely predicated on the narrative being that there's significant mine closures in the industry, and there was going to be some issues at the smelter level. So you could see the rising prices, but what we've historically seen is a pullback, because what generally happens is your treatment charges begin to drop, and that's what exactly happened in the refining costs. And coupled with the high prices, we saw a lot more concentrates come on stream, which is given to the position we're at now, where we've got lower prices. But having said that, historically in the lead zinc space, for instance, on zinc, we've used 85 cent as a long-term consensus pricing. I think now moving forward, you'll see that pushed up to $1.10, maybe even $1.20 moving forward, and that's actually a more significant number than the recent $1.40, $1.50 per pound we've seen, because that's what we'll be using for our financings, and the banks will use to determine whether projects are viable. So I think we're in the phase of the zinc market, what I would call the more mature phase, where you're looking at the long-term pricing stabilizing, which to me is, I think, key, and it's probably key to the bankers and the institutions looking to invest. Certain things catch us off guard, though. You know, Canadians, when Wayne Gretzky was traded, was one of them. Bill Cosby's in jail, two. And then one number that comes out of left field, 45. 45. Oop, went the wrong way. There we go. Hang on, no. There we go, 45, the 45th President of the United States. What Donald Trump's, as Eric alluded to, talk about trade the trade tariffs really did impact the market. You could see both copper, lead, zinc, all the base metals, I don't want to say fell out of bed, but I think it's a temporary impact on the markets. We will see that recover as that works its way out. So going forward, we expect to fully see, reasonable lead zinc prices, $1 lead and $1.20 zinc going forward, which is where we're using the PEA numbers at. So just in closing, so now that we've determined or will be able to determine the viability of the ore body, I think we're going to step back a bit from the project and see how big it is, how much ore is there. We've underpinned the value, we think we'll underpin the value with the PEA. It's open in all directions, and we want to check some of the other showings we have, so we'll be doing further work next year on that. We'll continue our metallurgical work. We'll expand our environmental impact study, and we'll prepare our application for mining development and permitting. And then we're also going to do some condemnation drilling to make sure where we put the infrastructure, there's no further ore there. So I'll be at the booth after to answer any questions, and I think there's a Q&A after if you would like anything specific. Thank you very much.